All right, guys, this is being recorded, and I say it at the beginning of every single webinar is watch this again. After this webinar is over, we're going to send this out to you guys. So watch it again because it will make some of these nuances that I'm talking about stick into your long-term memory. Even if you know this strategy or are familiar with it, I'm going to be teaching it a little bit different and have specific rules that you need to follow in order to implement this strategy. So for all of that, it's so much better just to watch it again because you will remember it. If you watch it a month down the road again, you're going to have to learn it all over again. And it doesn't have to necessarily be this exact same webinar on the long call butterfly. You can pick another one. I've done it before. But when I'm doing these strategies for the webinars, I have different scenarios that we need to think about specifically for entering that trade. So go through that process with me and then maybe watch it another way because that might help you remember it better as well. All right, so one thing to note, we are talking about the long call butterfly with a bullish assumption, all of those things. We are in the bullish bias kind of category, but we want to forget about all that real quick because we want to go into this like we're really setting up a trade for our assumption. So I'll go over that a little bit better once I get some of this stuff out of the way. My name is Eric Wilkinson. Some of you guys may recognize me as a Wolfman from CNBC or Fox Business, maybe even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started out trading in college and have been trading for about 25 years. Worked on the floor for a little bit better than 20 plus years there. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. Any opinions, news, research, and analysis or other information contained in this webinar or provided by Pro Trader Strategies, associated companies, or employees is for general commentary, does not constitute investment advice. You guys, I don't know what's in your portfolio, so how in the world can I tell you what to put in your portfolio? I don't even know your risk parameters. I don't know if you've traded options before or you never traded anything at all. So all of that being said, please do your own homework and remember past performance of any trading system or methodology is not necessarily indicative of future results. You can also follow me on Twitter at Wolfman's blog, especially during earnings season because I tweet out what earnings trades I'm doing, win, lose, or draw. You can also follow our parent company at Pro Trader Strat there. I see a couple questions popping up real quick. It was advertised that this was going to be the long call diagonals. Is this old or coming up? It was my understanding it was going to be the long call Christmas tree, and diagonals will be coming up, but not today. Is that right? We all good? I could double check on what it was, but I'm pretty sure it was this one. What's up, Trevor? Oh, somebody was saying the diagonals on all this? I thought my thing popped up and said I was doing it on the, not that I can't do it on that. We're going to have to do it on the Christmas tree on this one, though. All right, so basically when we come up with a strategy, everybody, let me check something. Let me see if I can figure this out real quick. Anyway, we're going to go with the, everybody okay with us doing the call Christmas tree? It's a bullish strategy anyway. Good with that? I'm all set up for it. I'm sure it's going to throw everybody off at home base too. All right, everybody's good with it? All right, good. Hopefully I can fix this somehow. I'm just double checking here. It is the call diagonal. All right, we're going to do it on the Christmas tree, though. It's still a bullish strategy, and it's going to fit in and around this environment perfectly, so let's go with it. Without further ado, so what do we usually do when we set this strategy up? We usually come in, we have to have a market assumption before we start out with anything, right? So with this one, what we're looking for is, you know, the market is trading right around here, and my pen doesn't want to work there. Is everything going to? So, you know, obviously with this strategy, we're not looking for a parabolic move, like it just goes straight up like that, right? What we kind of want is a market that's trending slowly higher, okay? So we don't want anything with a major market move to the upside, but as you can see, we want it to trend higher for us, okay? And we don't also want something that is trending higher for us like that, because that, you know, will give us a lot of whipsaws. There's better strategies for it. So we kind of want something that is going to trickle up and maybe kind of go to our target. Maybe it's a Fibonacci, you know, it's the 60 something Fibonacci or whatever. Maybe it's the SMA or whatever your reason is for it to coming to this level and kind of settling down. That's what we're looking for. I'm usually looking at like the Fibonacci's or maybe the market profile or something like that. Whatever our assumption is, we want that market to have that trend where we trade up and we kind of have a target in mind where we're going to go to. All right. So that's the idea with this strategy, is we're looking for a trending market that is going to find a spot that's going to settle down. And it is a twist to the butterfly. So as a matter of fact, when we set this thing up on the platform, it's going to call it a butterfly. It's on the floor, we called it the Christmas tree. Some other people, you know, have referred to it as the 1x3x2 butterfly spread, because what we're doing here is we're coming in and make sure my pen is still going. The one, we're going to be buying, or sorry, we're going to be selling that call. This is the one we're going to be selling. So we're going to be selling calls here. We're going to be buying calls here, and we're going to be buying a call here. So ultimately what we're doing is we're going to buy a call that's going to be at the money, this one call, and then we're going to sell 3 calls that are out of the money, and then we're going to define that risk. So it is a defined risk strategy, which is even further out of the money on these 2 calls, okay? So ultimately, we're kind of buying a call spread. We're buying one call spread here, right? And then we're selling a call there. And then we're going to also be selling 2 extra calls and then buying 2 calls, all right? So that's what creates this Christmas tree. And I'll show you a little bit better detail here. This is another example, you know, what I just showed you. You're buying the long call spread. That's the one where we're buying the call, and then we're selling that call, and then we're selling the short out of the money calls. That's the sell call, and then buy call, buy call. All right. So that's what this is showing you here. It's another way to look at it. I look at it basically from the standpoint of you're buying the call spread, selling 3 calls, and buying 2 out of the money calls. The reason I look at it this way and remember it is because on the floor, a regular butterfly, right, we basically do 2 strikes that are the same, right? And then we have one that's further in the money and one that's out of the money, okay? So that creates what we used to call the butterfly. Now with this one, you know, it's a little bit upside, but we're buying that one that's at the money, and then we're skipping this strike right there. We're going to skip that one, and then we're selling 3 strikes here, and then we're going to buy 2 strikes up here. So ultimately what we would look at it as the Christmas tree that way. Whoop. All right. So that's what makes that a Christmas tree versus the butterfly. And that's how it kind of came up with this name. And after we build this thing out, it's going to look like the butterfly, but it's got a little bit of a difference. You can see right here, I'm going to have to pull up a different thing real quick. Let me pull up my other little marker thing to mark up the platform here. So on this one, you can see this angle right here. This angle is a little bit steeper than this angle here. A regular butterfly would look like this and then have pretty much equal angles here, all right? Maybe a little bit off, but you get the idea. And then the break evens would kind of be right in here, all right? This one, you can see it is more of a angle that way and kind of built out that way. All right. So the reason why we have this longer slope here is because we've added a little bit more risk on this side. Okay. And that's what's drawing that angle out a little bit. We're increasing our probabilities of success, but in order to increase our probabilities of success, we have to increase our risk. And that's what that is. Selling that extra short call spread here on this example is what adds that as a risk. Now, remember when I was talking about the skip strike, and with this underlying, this is a little bit older example. You can see the underlying is trading at $47.30. That's where the underlying currently is. Now, we've done the 47, and a regular butterfly would be the 48, right? Well, we're getting rid of this. We're skipping that strike and going to the 49 and then the 50. All right. So we're skipping a strike. Also, if we were looking at it like we wanted to, if it was a regular butterfly, you know, it would have been like the 47, 40, or the 48, 49, 50, something like that. What we are doing is getting rid of this 48 one. All right. So we're getting out of that strategy. Oh, I must have put that up on with the other one. All right. A couple of other things to note with this is we are trying to get this very close to delta neutral. As you can see down here, +1 on the delta neutral, or is pretty close to delta neutral. We are slightly bullish because, for one, we need to get to this point right here to get to our max profit. And that's where it has to end on the very final day of expiration. Now, what's the probability of all that happening? It's pretty slim. So we are going to take a bit more or a bit less of a max profit potential. So I see a couple of, all right, everybody's good. Thank you. I'm going to Chicago in a few weeks. Any good places to eat? Trevor, talk to me after the thing. I've got great places for you. What do you look for to determine if the move will if the move to the target will be a slow move? Trevor, we'll go over some of that when we pull up the charts. It's usually going to be the more boring stocks, you know, maybe like the staples or something like that. Stay away from text with this for the most part. Peter, if you are bearish, then yes, this will work with the puts. All right, you don't want to let me erase you. Get rid of all that if I can. All right. Okay, so that's something to note. So the skip strike. Now, something else, if we were looking at this with, you know, different strikes, maybe it's $100. The underlying is $100. So we're having bigger, probably strikes. Okay, this is or let's just call it the stock. It can be an ETF too, stock or ETF. All right, that's where it's trading right now, $100. And so we're going to look at like the 100 strike and maybe go 110 strike because we're skipping that 105 strike. We're going to skip, right? That's the one we're skipping. And then the next one would be the 115, okay? Because those are going in increments of 5, all right? You know, if it was a $50 and we went to the, say, the 56, well, we've skipped 6 here, so we need to do half of that going up, so then it would be the 59. All right, see how I'm doing that? Basically, whatever this skip strike is, you know, or whatever this distance is here, we need to do half that distance here. Does that make sense? So half the distance over there. Okay, cool. So my essentials to success for some of you guys that may not be necessarily familiar with my teaching strategies and stuff like that, I go through what we need to do in order to set up this strategy. We came up with our bullish assumption already, so that's the first thing we need to do is we've got a bullish assumption, all right? So we know that. But picking the right underlying, this is something we're going to have to like look at our option montage and pull. Oh, I lost my other. All right. We're going to have to pull up this option montage. Hold on. We need to get my platform first. Pull this over here. So we go over to the option montage. Let me close that up. And what we want to do is look at where the underlying is trading. And this is Johnson & Johnson. So we move the decimal on any stock over $100, 3 ticks to the left. 1, 2, 3. So right now we are looking at about a 15-cent wide, right? Because I've moved it 3 ticks. 1, 2, 3. So that's 15 cents wide. Then we come down to this area and say, all right, is this 15 cents wide or less? And you can see that normally we are getting that kind of market on these ones that are just out of the money. And you want to go about closest to 45, 35 days to expiration. This is the closest one to that. It's becoming the spot month. People are getting out of this month here, getting out of the May, and they're rolling their trades out to the June. So this is becoming a spot month, which means that's where the most time and volume is being spent right now. That's where all the participation is. That's where the most free market price discovery is happening. And that's what creates tighter markets. All right. That's what we're looking for. So stock over $100, move that decimal 3 ticks to the left. We got 15 cents for this one. If it's under $100, a stock under $100, let's say Activision, then that is just a blanket 10 cents wide. Any stock less than $100, we are looking for 10 cents wide on these on the option montage. And this is during open markets. All right. All right. Open markets, we have to have that rule. After the markets are closed, remember, everybody's canceling their orders, so the markets are going to get wider. So when you're checking this rule, less than $100 stock, then we need 10 cent wide bid ask, okay? And that's during open market operations. So that's the rule for picking the right underlying here. Let me pull up another one. So the next step we need to do, we found out, all right, we've got a bullish assumption in XYZ. Now I figured that that underlying is appropriate to trade options. Now I need to think, okay, well, I've got the underlying, I've got my bullish assumption. I need to know what the environment is in order to narrow down what type of strategy I need, right? Well, the beauty in this strategy is picking the right environment is open. We can pretty much use, it's pretty open. We can use anything on IV percent. But I find it the best to be the middle of the road. 50 IV percent is the one I want, because ultimately we want this IV percent to go down. That will help us, okay? But this strategy, with that being said, we don't want a lot of volatility in this underlying while we put this strategy on. So it's good to put on after earnings, you guys. This is a great one after you've seen the underlying have its earnings, and we expect the market to start trending up. Maybe they came out with pretty decent earnings. Maybe they're in line, but you're thinking, okay, it's going to slowly trudge higher. Okay, put this on after earnings, because after earnings we expect the IV to go down. All right, even if it's low, we expect it to still come out, because an earning event is a binary event, and that creates uncertainty, and that uncertainty kind of creates that turmoil in a sense, all right? So we see that coming in, but once that earnings event's out, everybody knows all the information. Everybody's on the same page, and that volatility will consistently come out, all right? So that's the kind of environment we want. It doesn't really matter what our IV percent is. I would stay away from an earnings trade with this, because you know, you're adding more risk to the upside, and you expect this to really stay as a very inside move. Like, you're expecting this market not to move a penny or so. You know, $1 or $2 for an earnings event is not a very big move, and that's what you would be expecting. So I would stay away from this one. As a matter of fact, I don't even teach it in my strategies for earnings. But having said that, we do want IV to go down just like we would see in that earnings type of strategy. So picking the right environment, we want the environment to have implied volatility to go down, all right? And that's what we're looking for. And anybody who's trying to ask about, somebody's asking about implied volatility. With implied volatility, what we're doing is we're trying to look into where this underlying has been trading its implied volatility in the past in relation to where it is currently. So this is implied volatility down here, and we need to just know these numbers. 44, let's call it 45. The high here is 77, so 77, 45, and the low is 20. So that's the only thing we need to know, 77, 45, and 20. So we have a numerator and a denominator, right? So in the numerator, we have to take the sum and divide it by the sum in the denominator. In the numerator, we take the current, which we said was 45, minus the low, which we said was 20, and then we divide that by the high, minus the low, which I think was, I said 70, did I say 77 minus 20 there? So we've got 25 divided by 57. So we are trading in around, I would say probably the 45 percentile for this particular underlying, 43. So I did the math in my head. So Activision is trading at about a 43 percentile, but that's how you come up with that. Take the current, minus the low, and divide it by the high minus the low. And that's how you come up with the IV percent. So having said that, if there's no earnings in this particular underlying, in this month right here that we're going to be trading, then we're good to trade it because we would expect this volatility to continue to come out. So Activision might be a good one that we can look at when we start pulling up the platform and going through specific details on underlyings that will work with this. All right, and picking the right duration. Now, normally when we're doing debit spreads, when we're usually doing a debit on a spread, when we're doing a debit on a spread, we usually want to go for long duration, right? Because we want days to expiration. We want long days to expiration because it gives us enough time to be right. But because we've got this short extra call spread in there on that butterfly and everything else that we're building this out for, we've got 3 total short calls. And remember on that chart, we saw it kind of do that. Well, we want these 3 short calls to expire worthless. All right. And that'll happen if the underlying is trading right here on the expiration, which we aren't going to hold this strategy that long, but that's the idea. If we held it at expiration and our 3 short calls were right here at the 100 strike, that underlying would have to be trading exactly 100 for us to get the full profit on it. All right. Actually, it'd probably have to be trading 99.99 to get the full profit on it because that would cause these to expire worthless. So with this strategy, we want that theta decay. So the duration, despite the fact that we're doing a debit, we want to be as close to, 35 days to expiration is what we're looking for here. We're just outside of that, closer to 50 days. That's what's going to work because the ones that are closer to expiration right now are already decayed out. I wouldn't go there. You're going to have to really dig deep to find something that will work. So we're going to be going a little bit further out for this strategy. So picking the right duration, we're going to be picking something closer to this area. This is usually what I'm talking about. This is that theta decay component at the money strikes right here. This shows what their theta decay is. You can see out here in time, the further out in time, it kind of flattens out and we really ramp up the theta decay in here. And remember, that's where we want those short calls to get that theta decay. All right. The long call that we have is in the money at this point, right? hopefully, if we're directionally right. So it's going to be gaining value from the deltas it increases, the increasing in deltas, okay? Just like the stock kind of. But we want those 3 short calls to experience this type of theta decay. And the best theta decay is inside of 35 days to expiration. So we're going to be getting in right around in here, okay? And that gets us into this strategy right before we get all of that theta decay happening, which is what we're looking for from this strategy. All right? And picking the right strikes. The key to this here, we've talked about it. We've got that skip strike that we've talked about, right? We're skipping a strike. That's key. We skip a strike to make this thing work. We also are making sure that our debit, we want our debit, we want our debit to be less than 25% the width of our skip strike spread. Here, I'll just do this. All right, so 25% the width of our skip strike spread. All right, that's what we're looking for from our debit. So in that one example, remember I gave you the 47, what was it? 47, 49, 50, right? This is the skip strike. That's $2 wide. So the most we would be willing to pay for this strategy is 50 cents, right? And in that example, we were actually paying, I believe it was like 25 cents. So we were well inside of that. But on a $2 wide one, we want to pay less than 50 cents, okay? It's our rule for that. Oops, I don't want that back on. All right, so that's the rule on the strikes. And if you go too far in the money, if you go like in the money on the one that we're buying, and then we go at the money on the ones we're selling, and then we go out of the money on the one we're buying. The further in the money we go here, and if we're like slightly just a hair in the money on these at the money, it won't work out, okay? So we have to basically start shooting for at the money here, and if it's in the money, it's very slight in the money, okay? So that's picking the right strikes. We want to pay less than 25% the width of the spread. And then getting out, we need to know our exit strategy here. So getting our exit strategy, we want to get out at 50% of max profit. All right, 50% of max profit. One thing to know on this, when we were looking at that 47, 49, 50, right? Oops, 50. And I think it was, let's say it was 25 cents. All right, our max profit is right here. It's the width of the 47, 49. That's where we get our max profit. Well, we paid 25 cents. So the width of this spread minus the debit paid there. So our max profit is $1.75, all right? Well, we're only looking to get out at about 50% of our max profit. So half of 175 is going to be right around, what is that? Let's call it 85 cents or, sorry, 85. I was thinking 86 cents, but right around 85, 86 cents, right? That's when we're getting out of this strategy. 50% of max profit, all right? So when it increases from 25 cents to 85 cents, we're out. We good with that so far? All right, I kind of mentioned some of these already, but we've got the max profit on this. All right, the width of the long call spread. Now, on this, I have it written down as the long call spread, but remember, we're buying a call, that's the call, and remember I mentioned we sell a call. Well, that's the long call spread. We're also selling another call, buying 2 calls, and buying a call, right? But this is that long call spread, and it's got that skip strike in there, remember? So that's why I gave you that example on the 47, 49, 50. This is the spread we're looking at, so it's $2 wide. So my max profit is $1.75 on that example. Because remember, I paid 25 cents for it. Okay? So that's my max profit. It could, when it's going up, yes, when it's going up, if I bought it for a debit here, it's going to increase in value to that 85 cents. And that is your 50% of max profit. Right? Good there? All right, cool. And then max loss, beauty in that is, obviously, I skipped over real fast because it's the debit paid. Anytime we are doing a strategy for a debit, this debit paid is all we are at risk. So we don't have to worry about it going there. All right. Now, our break evens, though, is going to be when the at the money long call plus the debit paid. So in that example, we were given the 47, 49 again, 50, right? Well, my break even on this bottom one is the 47 plus that 25 cent debit I paid. So my break even on the downside, break even on the downside is the 47.25. And then on the long call, it's half the debit because remember, we've got two of them. Remember I said we were doing a long call, selling 3 calls and then buying 2 calls. So these 2 calls, we've got to split. We got to split that for the 2 calls. All right. So basically, $50 and what 12 cents is going to be my break even to the upside because this credit gets or this debit gets split in half on it. All right. Actually, sorry, minus. I was adding it in. So 47 is plus the debit paid. And sorry, this 50, we subtract half of it because of that debit paid. So it's 49.87, right? Ish. 88. So that's our break even to the upside. Sorry about that. All right. So debit paid is our max loss on that. I'll pull up the platform now. This is where I have it thrown out to you guys. Start throwing in the window there. What kind of, which ones do you guys want to look at? What kind of strategy or what kind of underlyings do you look at? Are you comfortable with? And you think you're going to get a little bit of a rally, you know, maybe a few dollars here or there, and then it's going to kind of settle down. So we don't want a massive rally out of it. Okay. All right. Somebody, AMD just came out of earnings. Okay. That sounds good. Then we'll take a look at that. My platform will pull up. Can you do ETFs like SPY? Yes. One thing with the SPY and SPX, if you are trading 10 lots in SPY, you really should be trading SPX. Okay. Because it's going to save you on the commissions. All right. When again would you use this? Would this strategy be used for? Where we are looking at something. Let's take a. All right. We'll take a look at the platform over here and pull this up over here. So this would be something where we're looking for the underlying to kind of. Slowly trudge up. You know, this is a pretty good example where, all right, if you thought volatility was going to come out, they just came out with earnings. They slightly missed on it, but it looks like everybody's kind of forgotten about that. So let's just say we're slightly bullish on it, and we think it's going to go to the 30 strike right here and settle down. for whatever reason. I mean, you guys could be looking at your Fibonacci. Maybe you pulled up a Fibonacci and it's up against a support or resistance. I'll just kind of try and throw this out here real dirty, real quick. But yeah, it's kind of lining up with the 29, 30, whatever. But for instance, you thought it was going to come up to a certain level and settle down. So that's where we came up with our assumption. Now, we want to go to the ones with the closest to 35 days to expiration. If you're dealing with an underlying that has really tight markets like Apple, Advanced Micro Devices has it, AMD, you know, then you could go over to these 36 days to expiration. As long as they have really tight bid offers, then I don't have a problem using the weeklies either, okay? So we have implied volatility of 17. You know, it just had the earnings, so we would expect the volatility to continue out. So I'm going to be looking at the ones, it's trading 28. I'll just do the at the monies, the 28s here. So we buy one of those, and then we skip the 29s and sell 3. 1, 2, 3, and then we buy the next strike out and buy one there. So we skipped a strike here and didn't buy enough. So 1 by 3 by 2, you see it says a butterfly even though it's not, and we're paying 21 cents. So it's $2 wide, 50 cents is our rule here, right? Because 25% the width of this strike, it's $2 wide, should be 50 cents. So we're good. You know, this is what I was talking about. If you went like this and then sold 3 of these and then bought that one, you can see that it is 50% the width of the strike. So that's why I was saying you can't go too far in the money on these. It's not going to work out. So we bought the 28s. We think it's going to go to that 30 strike. So we're selling 3 of those and then buying 2 of the 31s. All right. So that fits the rules. So let's just take a look at it on the Analyze tab. We can see what it looks like there. Make sure I get my numbers right on this. So 1 by 3 by 2, we're good. So I'm going to go over to the Analyze tab and see what we look like. So this is that same idea. If I switch this up and let's just make it one more and change this to the 29s, you can see that's your regular butterfly. You can see how these angles are equal distance. That's the thing I was trying to draw for you. It wasn't very well done. And then that is the broken wing butterfly, right? We've talked about that before. And the difference with the Christmas tree. The Christmas tree, we have defined risk. We know our max loss. The broken wing, we don't have a max, or we know our max loss, but we also have eliminated our risk on one direction or the other. But this, we are capping the risk here on this side. So we know we have some risk here, but it's not as much on this side. With the broken wing, we transfer this loss to the downside here, all right? I don't want to get too much into the weeds there, but this is what we do with the skip strike, and it makes that angle a little bit better. So that one works. You just can't go too far in the money. Somebody else wanted to see my Johnson & Johnson, J&J. Let's take a look at J&J. Hold on, let me get over here first. J&J, get rid of this. J&J, closest to 50 days to expiration. That's right. 14 cent wide. So move the decimal 3 cents to the left, 15 cents wide. We've already determined this fits that rule during open market operations. It's trading 141. So we're just going to go to that one that's just slightly in the money. We can play around with all of them. But let's go with the one that's the 40 strike first. So we're buying one of those. And then we're selling 3. We're skipping the 45s, going to the 40 or the 50s, and then we do the 55s and buy those. So we got the 1 by 3 by 2, and we're paying $2.75. So $10 wide. That's not fitting. That's a little bit wide. We'd want that closer to $2.40. So it might be because the markets have gotten a little bit wide. So 40. 1, 2, 3, and then 1, 2, Let me make sure. Okay, that's a little bit wide, so it's not going to fit. It did fit earlier today. It was actually trading 248. What calls div matter? Can you explain that a little bit more? With calls, does dividends matter? Oh, do dividends matter? Well, yes. So dividends do matter. I usually don't worry about the dividends too much. 90 cent. What happens is on the day of the dividends, this dividend date, the ex-dividend date, when somebody receives a dividend, the value on the ex-dividend date drops, or the price of the underlying drops by that dividend. All right. But you can see here, this ex-dividend date, it was expected to drop by 90 cents. It doesn't look like it necessarily did. This one didn't drop by that 90 cents. So it doesn't always happen. It's in theory. So I usually don't worry about the dividends too much. If it was like a big like dividend or something like that, or an unexpected dividend, then yes, you would have to worry about that, because if the stock's value lowers by that dividend, then that is going to affect your option premium by that directional move. Okay. All right. So let's do one more example with Johnson & Johnson. So we could do the 45s, check out the 50s, selling those 3 times, and then doing the 60s. So 1 by 3 by 2, you can see that one, see, further you go with your directional bias, then that makes it work. When you go too far in the money, then it doesn't work out appropriately. Okay. That debit $4 is well over that quarter that we were talking about. Somebody wanted ConocoPhillips. Oh, sorry, Capital One, Capital One. I don't know why I thought Conoco. All right, so we're going to be looking. I just want to make sure that our spreads will work here. Okay, so we got good ones. It's trading $92, $93. So we need to have it's under $100. So 10-cent wide bid ask during open to market operations. I believe this fits, so I'm going to go with it. So the 92 strike. We're buying that one once. We skip the 95s, sell the 7.5. So this isn't going to work out very well for us because we don't have the strikes equal, right? I would need to sell $2.50 higher. We can try this. Go 90, buy the 95s once, sell 2 of the hundreds, or sell 3 of the hundreds, and then buy one more out here, buy those twice. So 1 by 3 by 2, and we're right well under that 50 IV percent. ConocoPhillips, Banu saying, is only an IV percent of 11. And I feel you, but I'm assuming Trevor is expecting volatility to come out just of this market still. But my rule of thumb is when it's way down here, Banu is probably all over this. She's like, well, when it's way down there, you can see it doesn't stay down there very long. It wants to stay in and around this area up here. So maybe I'm expecting volatility to go up. Well, that's the beauty in all of our assumptions, is everybody's is different, right? And that's what makes these markets great. But if Trevor was expecting that to happen, then that would work. So somebody else threw out Facebook. Let's take a look at Facebook real quick. So Facebook, maybe we're just expecting Facebook to go up to, 205 or something like that, break through here and settle down. I don't know. We expect it to rally and settle down at a certain location that we found, right? So we go in here and we're saying, all right, we're going to take Facebook and buy the ones that are closest to the out the money or slightly in the money. That's these. So we're buying that one once, skip the 95s and go out to the 200, sell those 300. I would like this because I just think the 200 probably is a psychological level that would be tough to get through. So 1 by 3, I need to sell an extra 200. 1 by 3. So 1 by 3 by 2. And we build that out that way. If you guys are wondering how I build this out manually, what I do is I hold down the control button So when I hold down the control key, you can see all these hot, that's how you can tell I'm holding down the control key. So I'm buying 1, selling 3, 1, 2, 3, and then buying 2. So it is $10 wide. Our rule would be less than $2.50, so this one fits. All right. But again, I bet if I went slightly further in and bought the 185s, went to the 95s, and then did the 200s, that one actually works out. Usually when you start going that deep in the money, it doesn't work out, but this one is. So we would only expect this market to kind of trend sideways, maybe a couple of ticks higher for us. Well, Trevor, if you expect IB to go up, then don't do the Capital One Financial with this strategy, because if volatility starts going up, yes, it will help us with this in the money one, and it will help us with these out of the money ones. But we want to really happen is all of the premium that we sold to go to zero, right? Because that's where the money is going to come in, all right? And if the market rallies up there and all of that decays to zero, we'll be good. But volatility expanding on us because we're short all of these right there at the money is going to hurt us, because you can see the ones where volatility is being affected the most are the ones that are wanting the underlying to go to. So we want that volatility to come out, right? Because ultimately we want the market to pin where our short strike is. And when volatility comes out, you can see it affects us more. And then there's no adjustment. Good question, Peter. There's no real great way to adjust this strategy. You're kind of in it to win it, other than getting out of it when, we're getting out of this early. So our max profit on this, we paid $1.85, and then it's $10 wide. So $9 or $8.17 is our total max profit. We're taking 50% of that. So $4. So when this is trading right around $5.83 or something like that, that's where we're looking at. Right around $5. Okay. Why is the strike range better at the 90, 200, and 205? Well, the strike range is better because when you're coming out here, and it's a product of your pricing here, and the extrinsic value really is what it all comes down to. Did I do that right? One more in the 205s. So, the probability of me getting up to this $200 strike is a little bit less as well, all right? So are we bullish on the market in the next few weeks? I'm actually, Banu, have you not been watching the daily market commentaries? I kind of expecting this market to go down a little bit. Oh, all right. Well, without further ado, this is the option trading course. It's how to trade options like the Wolfman. It's a great course. If you guys have learned anything at all, or like how I teach, I know people will teach you the same strategy elsewhere, but, if you like how I teach, I try to do it where you can have these like little quirks or little things to help you remember it. Like, theta is the thief in the night that comes and steals your premium, stuff like that. I try and teach those things in my webinars so that you can remember it. So it's, top of mind and you don't have to go back. Peter, the Christmas tree is something that we called it on the floor. A lot of people call it a 1x3x2 or whatever. I just know it as the Christmas tree. So it's just easier to go with that. Does that make sense? You good with that? Yeah. And this was a really popular strategy on the floor, especially in 30-day Fed funds, which is what I traded. That was one of those things where, when we're in a interest rate increasing environment, which is what we've been in, right? Well, Fed fund futures would do this then, right? Because it's priced in and the market's continuing to just price in future rate hikes, which causes, bonds are a teeter-totter, okay? And as interest rates go up, let me get my pen. If interest rates are going up, then what happens with bond prices? They go down. So it's the teeter-totter. So as interest rates go up, then prices go down on bonds. So they're inverse. So as interest rates go up, Fed funds go down. But it was a great strategy with butterflies, because then when if interest rates start going down, then bond prices go up, right, on the teeter-totter. So bond prices are going up. This is great because it's just like a slow trudge up. Okay? And you take profit at 50% of max profit. What percent width do we want for the put tree? It's the same thing. 25% the width is what we're looking for. So I have all kinds of like little easy ways to learn just different option strategies and trading those earnings for sure. So this is actually for earnings trades. I'm getting myself all confused. Earnings with options. So right now we've got the implied volatility percent, IV percent really high. And I tell you how to take advantage of that, where your strike location is, all of that stuff for the earnings, when to get out of those, just kind of like I talked about with this long call Christmas tree, is that we are getting out at a profit target. I talk about that in these earnings webinars. So if you want to trade earnings with the highest probabilities of success, this is what we're talking about for the earnings. So you can take advantage of that. If you're watching this on tape delay, you got to type this up here into your URL. But if you are watching this right now, I'm sending it to you in the chat window. We've been going back and forth in the questions box. It's in the chat window over there. So you can click on that link. It'll take you straight to this course right here for the discount at $36. If you're watching it on tape delay, like I said, you're going to have to punch it into your URL. And finally, I want to thank you guys all for participating in this. Later webinars, I'm going to be drilling down on different option components, when and where I find those trades appropriate. Here's also the link. Again, you will have to pause it and punch it into your URL. Like I said, thank you guys all for watching. 310-598-6677 if you have any questions, or you can email us at trading@protraderstrategies.com. Peter says, great stuff. Thank you very much. I appreciate it. Can we use a GTC orders to close the trade? Yes, you can, Banu, because you bought it for a debit and you expect to get out at a profit target. Yes, you can do it. All right. Max profit, say $8. Do you sell it at $4 or when you make $4 above your cost? No, we're getting out at $4. Okay. Do equity fall in tandem with the interest rates? I believe is what you're saying. Do equities fall in tandem with interest rates? As interest rates are going down, that would indicate that interest rates are getting, as equities fall in tandem with the, I think you're saying interest rates, right? So if interest rates are going down, they're lowering interest rates, then that would expect that the economy is slowing and the Fed is trying to spur spending, right? That's the idea with the interest rate, is they're trying to spur spending to help the economy. So yes, as interest rates are going down, usually that's a product of the equities going down, because, you know, equities and stuff like that are forward looking, and they see the economy doing bad, they'll start rolling over and on the expectations. If they start seeing interest rates go down, a lot of times they start rallying because everybody wants free money. And that's what that kind of indicates, right? Yeah, the debit's got to be 25% the width. What's the daily market commentary? I talk about economic data. So I go through all the economic data and then I go back and talk about what the charts are showing, where I think the directional move is going to be. That's why I was giving Banu a hard time, because she didn't see that in there. But I don't have my chart up right now. My platform disappeared. But what I was expecting with the equities right now is we've kind of topped out, and I trade off the market profile, and it's got this, it kind of shows where the time and volume has been trading, and the market profile is showing that point of control is right here. So I'm expecting the market to kind of roll over just to that spot. And I think I don't know all the exact levels right now, but yeah, Amero says 2650 is where that point of control is. He's been watching the daily market commentaries. So that's kind of where I've been talking about it going there. Do you cover unusual option activities in your trading? I watch Pete and those guys and see what they're doing. I don't usually scan for that, but if I notice it, then yeah, I will, that could be, like all of a sudden I'm trading the 100 or the underlying is trading 100, and all of a sudden we see all of this volume happening at the 110 strike, then sure, that's where I'd want to sell those calls, right? Because it's going to go there and usually kind of putter out or something. But yeah, I'll use that stuff too, because it shows the inside money, right? Or the smart money, I guess I should say. All right, take advantage of that, guys. Like I said, it's over there in the chat window. I connected you guys there, or you can pause it, and it's probably been up long enough you can type it into your URL. All right, you guys have a great weekend. That's all I got for you. If you can't take that, take it easy. Oh, Neil, you can reach out to us at 310-598-6677 to get those daily market commentaries, or anybody else who's wanting to get those. Because yeah, and the other thing I talk about in those daily market commentaries is I tell you every trade I do, when I put them on, I usually put them on early in the morning, talk about those trades. I put this trade on, and then we go through it. If it starts becoming a loser, how do I manage that trade? What do I do to be mechanical and start beating the odds, all right? All of that stuff, or when do we cover this trade as a loser? And I go through every single trade I do, when and where I'm doing them, win, lose, or draw. If they're a loser and I'm having a bad month, you guys know about it, all right? Cool. Take care, you guys.